everyone, it is Evan here from the Trade Risk on Monday, June 3rd, here with video number 4 in our series on long-term market technicals. This is where we pull out the monthly time frame charts. We take a look at the big picture time frames of what's going on out there, long-term multi-year trends, to really pull ourselves out of the day-to-day and week-to-week trading decisions and really get a sense for what's going on in the big picture. And we do this on US markets, world markets, commodities, the whole spectrum, to really kind of understand where money's flowing, what the trends are like, and how this can help better inform our shorter term trading decisions. We do these about once a month. This one, in fact, is almost 2 months since we've done the last one. So we do have a decent amount to talk about. There's a pretty good theme right across the board that we'll get into in just a minute. But remember, these charts that we're looking at here on stockcharts.com, these are total return index charts in most cases. Okay, so that means there are dividends included. This is total return numbers that we're looking at, logarithmic charts. So we're going to kick things off here with the Dow Jones, and this is the full 10-year picture right now. And the theme pretty much across the board here for specifically for U.S. equities anyway, is that the month of May, which was the second, it's the second to last candle you're seeing here, this seemed to be a pretty much right across the board was a failure at resistance, or a drive down off of testing resistance, testing all-time highs pretty much across the board, and getting a failure or getting some sellers showing up at those prior all-time highs and driving us back into these ranges. We're seeing that across all the major averages, which you'll see in just a moment. But where that leaves us now for the Dow Jones is getting back to testing this 10-year trend line that is held since the '09 lows. We found support there in 2015 and 16, a little bit in 17. We tagged it or undercut it back in 2018, and now we're coming back down towards this area right now. So looking ahead here, looking at this monthly chart, remember each bar represents 1 month worth of trading. You can see that the Dow Jones has effectively gone nowhere since the very beginning of 2018. It's been in a sideways range. We had a couple of these thrusts lower here. All of those, dip buyers kind of stepped in. We recently got all the way back up to highs, and now we're back into this range. So looking ahead here, this 24,000 area in the Dow, that's going to be pretty important spot for bulls to hang on to keep the integrity of this longer term trend intact. Of course, there could be some noise around there. This is not a super precise drawn trend line. You can always refine this, but as the general sort of guide of slope over the past 10 years, this is going to be an important spot to hold this 24,000. If we start to see another month like May develop here, where we really just cut right through this and fall back below 24K and start, really closing below this trend line, then I think we do need to be, much more cautious or defensive, even in the bigger picture, and we have to think about a retest of the 2018 lows here in the fourth quarter of the year. So for now, Dow Jones rejecting off of these highs, coming back into the range, getting close to testing this trend line of support, and we're going to look to see how the month of June fares around this level, 24K. That's the big one to pay attention to. Now, if we go down to the S&P 500 here, you can see we got a little more room here before the shorter term trend line. Now, this one is extending really from the 2015-2016 area, and we tested that in 2018, and now that comes in around 2560 or so. But really, if we back up and look at the same story here, is that we had this nice 4 or 5 month rally off of the December lows to retest the all-time highs, and now we're kind of getting that thrust back off of them and falling back into this range. So once again here, we are mostly still stuck sideways, moving since 2018, the beginning of it, and really haven't been able to make meaningful new highs since that point. So a bit of a holding pattern here, and there's more room in the S&P 500 to just kind of slug it out sideways or maybe chop around here, which tends to be the thing that frustrates the majority. When we're not trending higher cleanly, when we're not trending lower cleanly, there's this period of chop, and that can be, that just is generally frustrating because we're not getting, directional movement in any one direction, and that could very well be the case here for the S&P 500. So looking ahead, 2,600, that's going to be the big level where the trend line starts to get tested again. Ultimately, though, we're going to need to take out the highs just over 2,900 to break us out to new all-time highs. That's your nice kind of momentum breakout signal that we'd be looking for at this point. Otherwise, we'll have to be patient in here as we trade back into this range. Now, if we go to the composite, it's a very similar situation. We are pulling off of the all-time highs, so we tag those all-time highs throughout the month of April and May. We're pulling back off of those levels. We're coming back into the range. We're still above the trend line here, which sets in right around 7,000 or so in the Nasdaq Composite. So we do still have some room before we get back down there and test it. But you can see we're pretty much in no man's land here. We're just kind of treading water sideways. We're not out. We're not above it, trending to new highs. We're not making new lows or lower lows. We're simply kind of stuck in a range here. And I think that's a good point to illustrate across all of the major U.S. markets when we look at the big picture. So it doesn't mean there's not opportunities in the shorter term, but for now, 7K all the way up to, north of 8,100, that's what's going to break us out there of the Nasdaq Composite. Now, finally, if we look at the Russell 2000 and round out our U.S. indices here, you can see this had a much different look than all of the majors going into the past couple of months or even to start this year. We were nowhere near all-time highs. We are still trading in a pretty distinct channel here that extends from the 2011 lows. We've been kind of grinding higher and oscillating in between this channel here, and you can see we are still in the bottom quadrant of this channel, but we're holding above the support. We're holding above that trend line. We're holding above where we found support in 2018, and that's going to be important going forward. So for the Russell, we're really seeking out here a higher low to get put in, something above 1,400. That's the ideal situation. We don't want to see the Russell kind of following through and just giving up all of this rally from the start of the year. We want to see a higher low get put in, ideally above this trend line. And of course, the sooner the better if you're in the bull case. Otherwise, really this channel, the integrity of this channel here is still pretty much in place. It's a obviously a big picture view. There's lots of room in here, but we're looking for that lower high above 1,400. And then ultimately to get some momentum, we're looking for a breakout over 1,600, which is effectively the highs from May. Now, if we start to look at some breadth indicators here, we have the NYSE monthly cumulative advanced decline line. And this here shows that, yes, we are in fact pulling off of those highs, but there's no divergence here that came in, or no real warning sign, certainly by the way I interpret this indicator anyway, of a ugly scenario unfolding. There was no, classic sort of divergence where, markets were all trying to break to new highs, or let's say markets were trying to test the all-time highs here in May, but when we looked at internals, we had some big divergence that suggested that the failure was likely. We actually saw the opposite. If you look here at the advanced decline line, this actually broke out in April to new highs. So if we look at this zone here in July of 2018 as the highs in the NYSE AD cumulative, we broke out from that in April of this year. And in fact, we're still above that line, that area, the prior highs right now. Now, I don't want to get too specific on, technical analysis on this, using lots of trend lines and overlaying any types of indicators here. But the point is we're still holding up quite robust when we look here at this internal measure of the market. So to me, this is actually still in a constructive sort of posture here, because it is very just mildly pulling off of the highs. It broke out in April. It's still holding that breakout. And this to me suggests that the majority of stocks are still kind of heading in the right direction here. So until and if we start to see a meaningful breakdown here, which it could happen, it doesn't mean that the markets can't continue to break down or pull back. But for me, this is a constructive sort of backdrop in broad indices that are pulling back. And there's no warning signs that this pulled out ahead of time. So for me, I do think that is a constructive on the broader landscape. Now, if we look at our number of stocks hitting new 52-week highs minus the 52-week lows, what we're looking for here as we start to pull back, or what we don't want to see, is the action that we saw in 2018 fourth quarter. We don't want to see this big draw out here to the negative side. We don't want to see a big sort of influx of stocks hitting new 52-week lows, and we would see that with more lines down here below, minus 100, minus 200, minus 300. We got one last month below this 100 level, which was our first kind of break back into red territory, and now you can see the month just started, so there's not really enough data to go on here. And in fact, it's the first day of the month, so we really can't even look at this candle with confidence yet. But what we basically are looking for is to get back above the zero line. We don't want to see expansion down here. We don't want to see us hanging back down and making new lows here and having numbers come back down into the minus 200, 300, 400 range. We want to see this dry back up and stay positive. That will help us, or that'll help show us some confidence and give us some confidence that maybe the pullback isn't as extreme and as fierce and may not develop to be as nasty as what we saw 6 months ago. So for now, something to pay attention to. We want to make sure that this doesn't continue to expand lower, and we'll keep an eye on that throughout the course of this month. Now, if we scroll down to the VIX here, we take a look at where it's trading. It's at around a 19 handle here, which is above its long-term average. Usually if we look at the 10 SMA here on a monthly chart going back 10 years, the VIX is at an average price of around 17. It's trading above it. Makes sense because the market's pulling back, but historically it's still it's below any type of extreme panic levels, and it's even below right now the highs of last month, even though prices are still below the lows of last month in terms of S&P or Qs or Russell. So a little bit of minor short-term kind of positive divergence, if you will, if you think about it that way. Otherwise, really not much else to say or analysis to convey here on the VIX, except for the fact that it's trading a little bit above its long-term average. Now, if we go down to the dollar here, the dollar's just continued to march happily to the upside. It's really been fairly smooth ride. It is looking like it's having a little difficulty here with the 2018 highs around this 97 area, but for the most part, this grind higher continues. It's still very much in a sideways range when we look back to 2015 with highs around 100, and 2017 where we briefly got up to 103, 104 area. So mostly the trend here on the very long term is still sideways with a slight bias to the upside, given the fact that we're coming from the bottom left to the upper right. So US dollar, not a whole lot to say. Still looks like there's room to $100 if this trend will continue. Now, another measure or another help of looking at broad market strength is looking at credit markets and looking at high yield credit. And this is where we have JNK, our high yield bond ETF proxy. And we're looking at this for any major divergences between what this is doing and what equity markets are doing. And you can see that JNK here, the high yield ETF, isn't really screaming any major warning signs at this time. There was, again, no major divergence. In fact, we saw credit continue to break out here to new highs throughout the course of 2019, and it's still maintaining above those highs. It is pulling back off of them a little bit, but nothing extreme, nothing that suggests a major warning sign at this time. Of course, again, just like internals, that can quickly catch up, and a month can make a pretty good difference. But for now, there seems to be pretty much contained panic here in the credit space. So if we go to our next index here, we're looking at the MSWORLD. MSCI World ETF here. So this is basically world equity markets minus the United States, minus the US. And if we look at this action here, it's still pretty weak looking. It has been underperforming US markets for the past for a while, but certainly since 2018 anyway, the start. it's been pulling back and has been kind of underperforming here. It did play a brief bit of catch up at the start of this year as this had a fierce rebound, but I'm saying in the overall structure, it hasn't been, a clean trend to new highs like the Nasdaq or the S&P that's been just kind of making new highs consecutively year after year. This year has been in more this gradual channel here, and we still find ourselves kind of now pulling back down to the lower end of it, and we're looking, just like we said in the Russell 2000 that was kind of developing in that broader channel, we're looking for a higher low to get put in here. Something above, 1700 certainly is kind of a must-have, but ideally something above 1750 to 1775 is higher up there, the better, as long as we don't totally retrace the action that we saw in the start of this year. That would be the ideal situation. So for the MS World Index, we want to see this start to put in some type of higher low, start to catch its footing, and start to find support at the bottom end of this channel. Now, if we start to move into emerging markets, you can see emerging markets here, this $41 area, that's where we really wanted to see this hold above. We kind of identified this big sideways range that started from 2010, 2011. We had the breakout in 2017, then we had this orderly kind of check back channel into it, and then we had this nice kind of breakout bar, and it looked like we were starting to get some lift off here back above, kind of a trend continuation retest, if you will, and now we're kind of retesting again. We've kind of abruptly failed there, and we're back to that $41 area, which is again kind of the upper end of this multi-year range, and we really want to see emerging markets hold in here, this $41 area, and get back above it as quick as possible. That's certainly the bull case or the bull hopes going forward here. So for EEM above 41, we're at it right now. That's what we want to see how we kind of follow up this month. It was a tough month in May, kind of bringing us right back to it, and now we're looking to see if we can put in that higher low and kind of successful retest to hold that 41 area. If we move into TLT next, TLT getting, started in April, getting that breakout from the shorter term kind of range here. And now this is just continues to make and trend into the upper right here to the bull's favor. Bond prices going higher here. And on the total return chart, we're threatening new all-time highs already. In fact, above 132, really, there's not a whole lot of prior supply when you're looking at a total index return chart. And right now, this trend is looking like it wants to continue here, even though it is, when we look at our shorter term charts, we know this is quite extended in the short term, but this is why having the big picture, analysis like this video's intentions is it shows us that, TLT has really gone kind of nowhere for 4 years now. From 2015, it topped out at 122, and then it's kind of just moved mostly sideways here. It certainly had its kind of ebbs and flows, but since 2015, it really hasn't gone too far, and now it's looking like it wants to try and break out here like some major kind of continuation pattern. Yet to be seen whether or not that can continue to sustain, but for now, that's certainly the direction, and the longer term trend continues to be at its back. Next up, if we look at gold here, looking kind of promising with the candle we have going so far, especially to start of June. We were really kind of tight, pulling off slowly, gradually off of that $1,300 area. We found resistance there again. And, when we looked at our, when we do our daily and week-to-week analysis, gold's been pretty messy over the past couple of months, really kind of been in a tough spot, not really looking to get too excited about it. But when we look here at the longer term picture and we smooth out all of that noise over the past 3 months, this looks like a potential kind of, call it a flag or just this high tight consolidation. And if we can start to get some traction here above 1320 and then, really 1350 or so, that's going to be the important area where we really need to see, or really would want to see, the bullish breakout. This is where we'd like to see the line kind of get, held and start to break out above 1325, which is last month's highs, as a starting kind of starting kind of breakout position. So gold here kind of looks promising. I mean, it's still very much sideways. So it's easy to get chopped around here, but 1350, 1325, some key areas to pay attention to, and that could really start to ignite a bigger potential move there. Now, if we go down to silver, this is not so exciting. This isn't as bullish as gold is. Gold is kind of hanging up, kind of hanging back up towards even multi-year highs. Where it's been failing is this 1350 area. It's trying to make a series of higher lows, even though we get a series of lower highs. Silver here is in a tougher spot. It's not, it's not as aggressively challenging resistance. In fact, it's kind of back to 14, closer to the $14 area, which is where it made lows originally back in 2015, and it's been trying to hold above that for the past 3.5 years or so. So for silver, we'd really want to see this story start to turn around as well, because generally speaking, silver in a bull market or kind of in the bull fashion, bull trend, really is the best time for gold as well. They kind of go hand in hand. You tend to like to see silver outperform gold. So here we're kind of looking for silver to really get a turnaround story, and right now we're not seeing it. It is much weaker than gold, and it's very much in this sideways holding pattern here. $14 is support. 16, upper 15s to 16 is really the breakout area that we want to see in silver. So this is something to watch, and watch that ratio between gold and silver in the coming days and weeks and months. Last but not least, or the last two markets we're looking at here is energy. So we're looking at crude oil first, which is had a really tough May, broke down from 60, pulled back from the $65 area down to the low to mid 50s. You can see the pattern here still not really clean whatsoever. I mean, it's almost looking like it's breaking down from another smaller wedge here, and right now it's kind of just on the bulls to potentially try and put in some type of higher low. There's no big trend to really look at here. It's gone mostly sideways from $40, $42 is the majority of its trading, all the way up to 70 over the past couple of years. We of course had this real capitulative move down into the 30s and upper 20s, but it's mostly a mess here on the big picture time frame, but that doesn't mean there's not opportunity in the shorter term to midterm outlook. Crude oil can definitely move, and it's certainly moving right now, but the move is to the downside. So no big relevant levels to really speak of until you get down to the mid 40s. Last but not least, we have natural gas, which is suffering a breakdown here, a multi-year breakdown below that 260 area. It's getting some monthly closes below there. It's making new lows on the year, and really it's just in a tough spot altogether. Natural gas looks pretty weak here. It would need to reclaim this support above 260 to get to get excited about it once again. But for now, it's just looking quite weak here and heavy. And until and if that turns around, it looks like we favor the sellers here as we're breaking to new, fresh, multi-month, multi-year lows. So that is it. That is the recap for the month of June as we set up into the month of June. It's June 3rd right now. So lots of things to look at here. We got equity markets coming off a failed breakout of all-time highs. We got bonds that are breaking to new highs. We got emerging markets that are checking back here. We got gold that's potentially squeezing above multi-month, multi-year resistance. So there's lots of things to really key off of in the long-term charts, and hopefully this helps inform some of your shorter-term decisions. I know it helps me when I go through these charts, so hopefully it's the same for you. And that's, I think, all I got. So thanks as always for tuning in and watching. You can subscribe to our YouTube channel or follow us on the Trade Risk, thetraderist.com/blog. Keeps you up to date with all of the latest that we're producing. If you have any questions, let me know in the comments section. Otherwise, have a great rest of your day, and we'll see you in the next video update.